Hey there! Enjoy the second part of our interview with Steve Gorelik. We've talked about the comparison of investing in the US and in Eastern Europe. We also took a deeper dive into portfolio concentration. So please enjoy the video, and if you like it, subscribe to my channel. Thank you! Steve, welcome back to the second part of our interview on value investing in Eastern Europe, or general investing in Eastern Europe. What are outstanding capital allocators and CEOs in Eastern Europe?
I think there's quite a few, and that's one of the things that what we've seen is that the companies that may not have known much about capital allocations have really figured it out over the last 10 to 15 years. One of the companies that comes to mind when you talk about capital allocation is a company called Georgia Capital, which is listed in London. And it is run by a management team that has a very strong track record of building value when they were leading the Bank of Georgia, which is also listed in London separately. And they spun out, so they were building value within the bank, but they also have been, over the times, there are certain opportunities that have come up that had nothing to do with banking, but it made sense to take advantage of them. So they did it using bank's balance sheet. For example, they had some real estate projects that they were developing over the years. They built a country's leading healthcare company as a result of being involved in a healthcare insurance, and then realizing that because of there's a public option, there's really the money is not being on the provider side, but being on not on the payer side, but being on the provider side. So, and as a result, they've invested in hospitals and clinics, and then they bought some pharmacies, and they've built a kind of integrated healthcare company that they then separately listed. So this is a team that have shown that they've generated a lot of value over the years by investing in these different projects. And part of how they do it, and they do it on the bank side as well, is that they very much focused on returns on invested capital. So if you talk to the bank CEO today, they ask him, okay, how do you guys make new loans? He says, well, we want the loan to have 20% ROE, and we price it accordingly. And I haven't heard that type of talk from a lot of bank CEOs, and I speak to quite a few of them. So these guys have always been very much focused on capital allocation. And last year, what happened, because all of these other businesses have become relatively large part of the bank's balance sheet, it made sense to just split it out into two companies. And Georgia Capital was listed as a separately listed company. It was spun out to the shareholders. It's fully listed in London. And the management team, the key management that have been building the bank over 12 years before that, decided that, okay, they want to go with this company because while the bank is great, they find the opportunities to allocate capital much more interesting here because they can do not just banking, but they can get exposure to all sectors of the economy. And the way that they're doing it is that they have kind of this approach that, okay, we have our two publicly listed companies that we invested in, which is the Bank of Georgia and Georgia Healthcare Group. So that's part of our NAV that's delivering value to us. Then they have a few areas where they can invest a lot of money at very good rates of return, with returns on invested capital of 10% plus. And kind of similar as ideas when Berkshire bought energy company, or when they bought railroad company, was a way for them to allocate a lot of capital, very good rates of return. So these guys don't have a railroad company, but they do have an energy company. They have a water utility where their returns on a regulated asset base have double-digit yields. So more money they put to work and making the network better, they get very good returns on that. They're investing a lot of money in renewable energy with purchasing power agreements that guarantee to them double-digit returns in US dollars. So they have a lot of ways to allocate a lot of capital, and that's why they got into those sectors in the first place. And then the third thing that they're doing is they are looking to consolidate certain sectors that they participate in, so to establish a beachhead by buying an important company in a sector, and then either spending money organically, once again, at high rates of return, or if there's opportunity to buy other players, they can buy them, and they have lower cost of capital than other Georgian companies because they are listed in London. They raised a bond when they listed separately last year. They raised a $200 million bond at very good rate, very good interest rate. So they have a cost of capital advantage. They are very good at capital allocation, and they're combining those two things to be able to find opportunities that generate a lot of value to their shareholders, including us. But the other thing that they do is that, okay, if the value available in our shares is better than what we can do by deploying capital in the market, then we'll just buy back our own shares. And the value since the company listed last May 2018, has been good. So they bought back within a little over a year, they bought back 11% of the shares that was outstanding at the time. So it kind of really shows you that they're putting their money where their mouth is. And management gets paid in shares primarily. So it's really a situation where we feel very excited about how these guys allocate capital and the future going forward.
Yeah, it gets real that you have a high conviction about this stock and you're very convinced about the company. So could you give us some insight? How do you approach position sizing and portfolio concentration in general if you have such good ideas?
Sure. So one of the things that we find about investing in emerging markets in Eastern Europe is that no matter how good the idea is or how comfortable you are with the management, there is a chance that something might happen that you just don't expect, like either a macroeconomic story that influences a particular sector of your portfolio or something else that you did not expect. So because of that, we run a much more diversified portfolio than we would want to, for example. So our top 40 positions represent about 80% of the portfolio, and then we have a kind of long tail of smaller positions that either we're building up to be a bigger position, but it takes time, or it has a really compelling risk reward, but it can be zero, it can go up 10 times, so we make it a relatively small part of the portfolio. But in general, we try not to have any position over 10%. A company like Georgia Capital that we feel pretty good about and have high conviction, it's about 4% of our portfolio, and this is a good size because we have to keep in mind the liquidity. 40% of our fund is our own money, but a lot of the things that we invest in are really liquid, relatively speaking. We'll buy companies that trade $100,000 a day, and we'll build our position over 6 months. But we don't want to be caught in a situation where investors saying, okay, we want our money back, and then it influences what the remaining investors, the value of the remaining investors in the portfolio. So with companies that are less liquid, and Georgia Capital is somewhere in between, it does about $1 million per day, which we would consider medium liquidity. But we would try to manage the portfolio in a way, okay, this much can be medium liquidity, this much has to be highly liquid, this much has to be in things that are completely liquid but are very interesting on their own.
Can you tell us more about the steps you do in your process to get the conviction to invest?
So we start from top-down analysis. So the first thing that we do is we want to identify the macroeconomic, both the countries from a point of view of the rule of law and from a point of view of the economic trends that we find to be supportive and positive for a country as a whole and then for particular sectors within the country. So that's the start, because we may find a company that we really like in a country that has issues. We're not going to touch it because we find that in emerging markets that macro and kind of the country will sweep away nothing, no matter how good the underlying economics are. And then once we identify the sectors, what we do is we start looking for companies, and then when we do look at companies, what we focus first and foremost is cash flow generation. So we try to find companies that generate excess cash flows because of their good business models, because of the moats they have developed over the years. And the second part that's very important to this part of the analysis is how they allocate capital, is making sure that they allocate capitals in a way that we would allocate capital if we would run that business. So as a result of that, and then that really narrows down our investment field into companies that then end up being in our portfolio. And within that, then once we find, okay, this is the company that we want to own, then we have a conversation about the liquidity, the risk profile, which country it's in, and kind of try to establish what should be the weighting in the portfolio as a result of that.
Interesting. If you compare the processes, you're also investing in the US and in Eastern Europe. What's different?
In US, we find that it is this macro portion has, I would say, I think less relevant is the wrong way to say it, but it is not as important because you don't have to worry about the things that we talked about in the first part of the interview as far as understanding how the asset was created, understanding the players. Well, it's a little simpler in a developed country like the United States. So we spend a lot less time on that in the United States than we do in Eastern Europe, where, as I mentioned, like we have to be comfortable with how things are, how they allocate capital, because it's very easy to get into a value trap. You can buy companies at net cash, but you're never going to get that cash. And it's just not as common in the United States. So that's probably the biggest distinction. But from a point of view of the things that we focus on, and that's part of the reason why we started the US fund 7 years ago, is because we had something that we think works from a point of view of focusing on cash flow and how the cash gets spent. And I know a lot of value investors do that. But to me, it's a key part of we take kind of going back to my experience as an operational strategy consultant, we take an approach as if we were running the company, how we would make a decision, what we would do with the cash. And so that part of the approach is the same in Eastern Europe and in US markets. So from that part is the same, but obviously how we size positions is different and the macro part is different.
Interesting. What are special risks in Eastern Europe?
So with Eastern Europe, there is not, I think each country is different. So when you talk about a risk in Estonia, it's not the same as the risk in Russia. But there are things that you have to keep in mind, and especially if a asset has been created in a way. So I'll give a specific example that was in our market, where about a few years ago there was a situation with a company called Bashneft in Russia, which was part of a listed company in London called Sistema, and this is a situation where Sistema has received this asset shortly after the 2008 crisis, and the way that they got this asset was not 100% clear. I mean, there's different rumors going around. I'm not going to be repeating them, but they got the asset at a very good price, and they were running it very well. They were running it for dividends, and at some point it looked like they would have to sell the company at also a very good price for the buyer to another company in Russia called Rosneft. And we just never got involved in that situation in the first place, no matter, because even though Bashneft looked really cheap and Sistema looked really cheap, because we were not certain about how the asset was created, we decided that this goes into the too hard pile and we're not going to touch it. At the end, the transaction happened, and not everybody was happy with the price. And the Sistema shareholders, my understanding, were definitely not happy with the price. And on occasion, you have to worry about these things, but we address them by, as I said a couple of times at this point, by trying to understand how the asset was created and how it was made. Is this special about Eastern Europe? I don't think so. I think it's really the case for all emerging markets, and even sometimes in Western markets, is that you will have special situations. But one of the things that is probably misunderstood about investing in Eastern Europe, that these type of situations is really an exception as opposed to the rule. So that's the headlines that you're going to get. But you're not going to get a headline about a company doing the right thing day in and day out. And that's what 98% of the companies that we're in the market, they just do the right thing day in and day out. And they allocate capital and they make money, and then they take that money and then they allocate it again to what they consider to be value-added projects. And sometimes we agree and sometimes we don't agree. But this is no different than anywhere else. Meanwhile, you have macroeconomics, you have political risks in places like Kazakhstan, where if you had a particular person in power for a long time in Kazakhstan or in Russia, then there's questions about transition, how the transition would happen. So there's definitely risks. There's something to think about. That's why we feel comfortable investing in Eastern Europe. We don't invest in places in Asia. We don't invest in places in Latin America, because there's things that you have to worry about there that we just don't know. We don't want to be the patsy at the table, as Buffett would say. We're not the patsy at the table in Eastern Europe. We would be somewhere else.
Yeah, you're a value investor and have a portfolio full of stocks where you think they are undervalued. What would be your best guess on future returns from that portfolio? Is it different from like 10 years ago, or do you think there are good times ahead for you?
So from 10 years ago, definitely is the same, if not better. From 25 years ago, it's kind of hard to say. I wasn't there. In terms of how we think when we add a position to a portfolio, what we're looking for is we're looking for a return of at least 15% without assuming any change in multiple. And when you buy in things at 6 or 7 PE, well, that's kind of what you get, right? That's the starting point for us. And if we buy into something that is less liquid or in a more complicated situation, then we will look for a return of 20 or 25%. And then if things are working wonderfully and other people realize the value, then the multiple goes up, then the return goes up as well. And some of the best investments that we've done over the years is the companies where you come into a situation that is considered to be complicated. We had a view on it. Okay, things are improving. The corporate governance is improving. And you have a company going from 5 PE to a PE of 9 while growing earnings at 15% per year. And then you get a really wonderful return. And we had a number of companies like that. And it's something that we see that's working, that we're not counting on multiple expansion. On occasion it happens. We welcome it. We will trim the positions accordingly. But that said, if we're talking about a multiple today, we have a market multiple of around 6, which is historical range is 4 to 12. So that kind of gives you an idea of where we are. And I would argue that the top end of the range today should be higher than it was in 2007 because you have better quality companies, and plus the market overall is higher. So the top end is probably not 12, it's probably higher, but it doesn't really matter because we're at 6. So it's from the point of view of the opportunity, we think it's quite compelling today.
On a practical basis, how big is the language barrier if you want to invest in Eastern Europe?
I think it's become less. So people in investment, our investment team is 5 people. The founders had nothing to do with Eastern Europe until they started this business 25 years ago. One of them was an American guy who was a Russian translator in his earlier life. The other one was just a lawyer, M&A lawyer that had nothing to do with Eastern Europe. They saw the opportunity. That said, the other people in the investment team are from Eastern Europe. I'm originally from Belarus. We have another guy who is originally from Russia and another guy from Lithuania. That said, we invest in places like Romania, Bulgaria, where we don't have any native speakers, but we feel very comfortable investing in a place like that. Over the years, it became less important. So IFRS filings have become standard a few years ago. I think at this point it had been 4 or 5. So where my competitive advantage 15 years ago was knowing how to read the Russian accounting standard of filing, that competitive advantage doesn't exist anymore for me. Okay, but that said, it's much easier for anybody else to come in and look at the IFRS statement that looks the same as a German statement or a Belgian statement and is in English. So you will be able to get most of the information that we get without having knowing the local language. And then there's Google Translate, which is getting better every day. So I would say it's not a requirement. I think you have to have an open mind. You have to kind of get into the mentality. So being from Eastern Europe, I think helps from a point of view of like understanding the mentality and some of the quirks, but not the language barrier.
Another practical question. How can you invest in Eastern Europe? Like, can you go on your Interactive Brokers account and buy stocks from there, or is...
So Well, we're set up locally in all of the countries that we invest in. But I do believe, for example, Interactive Brokers a couple of years ago made a connection with the Baltic countries. So you can buy any Baltic security on Interactive Brokers. A lot of the companies that in our region are listed in London. So the way that you buy any company in London, you would buy that one.
Why are they in London?
London is a hub for European, historically it has been a hub for a lot of the countries from emerging markets, not just from Eastern Europe. It's where the investors are, and so the companies over the years have come there and raised money there and continue to operate there. Moscow Stock Exchange in Russia has become much bigger and significant player over the years, and you can see the volume of trading moving from London in the companies that are listed both in Russia and in London. The volume of trading is slowly moving to Russia. In terms of how easy it is to set up there, I believe it's pretty easy. I'm not sure if it's linked with Interactive Brokers, to your question, but it's not very hard to set up. It's a very modern exchange, and they really pride themselves in the quality of the offering that they have. So it's another thing that's becoming easier, and the region is more welcoming to outside investors. That said, I don't think there's that many. Like if you take a look at what's happening into capital flows, there's been some passive flows into the region, but the active flows have been negative to zero ever since 2008. So which kind of leaves active managers like us, gives us a lot of opportunities. It explains why we can buy great companies at great prices, because that's really like, you want to know like why you're buying this at this price. And we feel very comfortable with what we're getting at the prices that we're getting, because there's not that many people looking. I mean, we go to different industry conferences where if in 2007 you went to a conference in Russia and there was 200 people in the room and like 120 of them, 150 of them would be foreigners. Today you go to a conference in Russia, there might still be 200 people in the room, but there's going to be 10 foreigners. And we're one of them, or two of them, depending on how many people go. So it kind of tells you about how the markets have changed and who looks at these markets today. And that's an opportunity.
You're located in New York.
Yes.
So how does a typical day look like if you're researching Eastern Europe?
So first, we travel quite a bit. So we have 5 people on the investment team, and I travel once a month for a week. Whenever I go, I usually hit 2 or 3 countries. A lot of my colleagues do essentially the same thing. So at any given point, we have somebody somewhere in Eastern Europe. Not all the time, but quite often. So altogether we do, I think we counted last year, we did like 500 different company meetings, include some conferences, and there's some double counting in there, but we meet with a lot of companies. And so that's part of the investment process and a very important one. Then the first part of the day, so we usually start at like around 8, 9, and some of our markets are still open, but the markets close by 12. And so what we have, that we find to be an advantage, because most of our working day in New York is spent analyzing the situation without any noise that's coming from market movements, and which gives us the opportunity to step back. We have a very long-term investment period. Our average holding period is 7 years. So we don't react to daily movements. But not being in the market when most of your counterparties already went home gives you time to step back and say, okay, here's what happened today, let's think about it. And it gives us like a much more cleaner way to think about the positions. But meanwhile, from a point of view of trading, we have great relationships with a lot of the brokers in the region. They know that we're long-term investors, the type of investors that the companies like. So we feel comfortable putting in, when we're saying, okay, we want to buy a company or we want to sell a company, we'll put it in with a broker that we know, and we tell them how we want it to be traded. And when I wake up at 6 in the morning, I see what happened, and usually pretty happy with it.
So your strategy is more a kind of buy and hold strategy, or do you use actively trading to add returns?
It's more buy and hold. As I said, it's average holding period is 7 years. We still have some positions in the portfolio that since 1994. So if things are working well, if the company is building capital year in, year out, then we don't need to do anything. will buy a company, will buy 2 or 3% of a company, and will do the work for us. So, and that's what we're looking for. That's the holy grail of investing for us, where we'll just buy and then we'll never sell. Meanwhile, the company generates value.
Do you want to add something at the end of the interview we haven't discussed?
No, I think the most important thing is that part of the reasons why we do these interviews is kind of to tell people the story of Eastern Europe, the changes that happen there, the corporate governance changes that happen there. The 25 years is, on one hand, not a lot of time, but on the other hand, it's a lot of time for you to learn things. If you're trying to understand how capitalism worked after 70 years being in the Soviet system and the communist system, well, you'll make a lot of mistakes at first. But over the years, you'll learn, okay, this is a mistake, this is the right thing to do, this is the wrong thing to do, so let's do more of the right thing. And these are the changes that we've seen progressively happening over the 25 years that we've been doing it. And I'm really looking forward to seeing what it will look like 25 years from now. And the stigma that's around, because most of the people I would talk to, and I say I invest in Eastern Europe, the first 3 or 4 questions are about, well, how do you feel comfortable about the assets that you own? Do you really know that you own there? How do you deal with this risk? How do you deal with this macro risk? Like, okay, you definitely need to keep this in mind. But you guys are missing the point. You guys missing the point of what happened, that this is a company that is a world-class company. It just happens to be in Moscow, or it happens to be in Bucharest. But this is a world-class company operating within a rule of law that is applied consistently. You just need to know the rules. And they know the rules, and they benefit from them. And oftentimes they benefit, and they can run the company better than a Western company that's coming into the market. So we have some of the best investments that we have is banks that are run by locally owned banks that compete against Western-owned banks in a place like Romania or Lithuania. And they make decisions locally as opposed to in Austria or in Sweden or wherever it is. And there's a competitive advantage that comes as a result of that. And so, and an outsider would say, well, I want to own the subsidiary of a Swedish bank. No, I want to own the local bank as long as I can trust the management. So that's a change that has happened that we've seen with our own eyes that is not reflected in the multiples at all. So from that point of view, I think I would be happy to see the multiple go up. I think it will influence my opportunity set, but I want people to understand that the quality of the companies that are there, I encourage people to go and meet with the companies on the ground, and I can almost guarantee that you're going to be positively surprised by what you see.
Thank you very much.
Thank you for having me.